Let's be honest, the biggest hurdle to investing isn't the math, it's the mindset. Saving feels comfortable, right? You can see the balance in your account, it doesn't go down unless you spend it, and it certainly doesn't nosedive on a random Tuesday afternoon. But investments, they have a life of their own. They go up, they go down, and that volatility can be scary. It keeps a lot of people on the sidelines, afraid of losing what they've worked so hard to save. You might be thinking, I don't want to risk my hard-earned money. That's not just a fair thought, it's a smart one. And that's precisely why we don't just jump from saver to investor overnight. It's a journey with clear, deliberate steps. The first unskippable prerequisite on that path is your financial firewall, your emergency fund. Before you even think about investing a single dollar, pretty much every credible financial expert agrees you need 3 to 6 months of essential living expenses tucked away in cash. This money is not for investing. It sits in a separate, easy-to-access, high-yield savings account. This isn't your fun money or your opportunity fund. It's for true emergencies, a sudden job loss, an unexpected medical bill, or a major car repair. Here's the part people often miss. An emergency fund is what protects your investments from your own life. The number one reason people sell their investments at the worst possible time is because they get hit with an unexpected expense and need cash fast. Your emergency fund is the buffer that gives your investments the time they need to grow over the long term. Okay, once your emergency fund is locked and loaded, the next step is all about changing how you think about your money. It's called mental accounting. The idea that we treat money differently depending on where it comes from or what we plan to do with it. I want you to start thinking about your money in 2 completely separate buckets, a safety money bucket and a growth money bucket. Your safety money bucket is your emergency fund. Its only job is to be stable and there when you need it. No risks allowed. Your growth money bucket is for every dollar you save after your emergency fund is full. This is the money you'll be investing. Its job is to grow, which means you have to be okay with it fluctuating from time to time, knowing you'll never be forced into a panic sale. This mental separation is a game changer. It cuts down on the anxiety and stops you from making emotional decisions with your long-term money. With that mindset in place, it's time to take action, and you can start small. You don't need a mountain of cash to start investing. Seriously, most online brokerage platforms let you get started with as little as $50 or $100. The goal right now isn't to get rich overnight, it's to build the habit of investing. The most powerful way to do this? Automation. Set up an automatic transfer from your checking account to your investment account every single month. It doesn't matter if it's a small amount. Automating your investing makes it feel effortless, takes the emotion out of it, and builds the consistency that is the real secret to building wealth over time. Of course, this is where so many beginners get analysis paralysis. They think they need to find the next Tesla or become a crypto trading genius. The truth is, the simplest investments are often the most effective. For the vast majority of people, the best place to start is with a low-cost, broad market index fund or ETF. Think of an index fund as buying a tiny slice of the entire stock market. Instead of trying to pick one winning horse, you're betting on the whole race. You get instant diversification across hundreds or even thousands of companies. And you don't have to take my word for it. The legendary investor Warren Buffett has said over and over that a low-cost S&P 500 index fund is the best investment most people can make. You can hold these funds in tax-advantaged accounts like a 401k from your employer or a Roth IRA you open yourself. So, why are we going through all this? The answer is one of the most powerful forces in finance: compounding interest. Compound interest is what happens when your investments earn money and then that new money starts earning its own money. It's a snowball effect for your wealth. It might not feel like much at first, but imagine you invest just $100 a month over 30 years, assuming an average 8% market return. That could grow to over $136,000. And the incredible part? You only contributed $36,000. The other $100,000 is pure growth from your money making more money. That's the power of starting early and staying consistent. The path is crystal clear. First, build that 3 to 6 month emergency fund and put it somewhere safe. Second, mentally split your money into safety and growth buckets. Third, start small by investing automatically and consistently. And fourth, stick with simple, proven long-term investments like low-cost index funds. I'm genuinely curious, where are you on this path? Are you in the saving stage, or have you already started your investing journey? Let me know down in the comments. And remember this, saving money gives you stability, but investing is what gives you freedom. If you found this guide helpful, do me a favor and hit that subscribe button for more simple strategies to build your wealth. Thanks for watching.